Hi, I'm Peter Rose, founder of Longwood Currency Trading. The importance of entry analysis is the topic I'd kind of like to chat about today. I've had, going back through some of my emails, and I've noticed I've had some folks in their conversations with me keep asking me about entry analysis and why I stress it so much. The importance of entry analysis can't be stressed enough, in my opinion. This is early January of 2025. It's back in 2017 or 18 or something like that. Because of my failures in being able to be successful at trading and losing a lot of money, I had to step back from the currency market and look at it as a problem, the same way that I would as a software engineer, which I spent 33 years of my life solving complex enterprise level problems. And in that career, we used what was called a software development lifecycle, an SDLC. It was a process of breaking complex problems down and solving them in sequential order and hooking them all together. It's a complicated process within the solution of complicated processes. But even a complicated process can be simplified, and that's what I did. And I applied the software development lifecycle to currency trading, and I came up with what I called, and I've coined the term, the life cycle of a currency position. And that life cycle of a currency position, because that's what you have. If you make a trade, you have a position. A position is something that you have. A trade is something that you do, because you can make multiple trades to add to or take away from a current position. In any event, you have the life cycle of this currency position, which ranges from when you do the analysis and the entry to managing that trade, and then getting out of the trade. So the three phases of the life cycle of a currency position are entry analysis, position management, and exit methodology. And those three issues are problems. Entry analysis is a problem. Position management is a problem. Exit methodology is a problem. Can you think of any other problems? Well, no, because there aren't any. As long as you can have the ability to take the playing field that you're looking at and determine what the rules have to be in order to play in that game, and then how you win that game by developing those rules to solve the problem presented in the game. Regardless of the sport, it could be fencing, it could be football, you have phases that you're involved in and different techniques that you use, and you consolidate those into a package. There's the hike, for example, in football, American football. Well, there's a lot of theory that goes behind that. When are you going to do it? Where's it going to go? What's all that kind of stuff. And if you don't have a really good hike, then the poor guy who's going to have to pass at the quarterback, he's not going to have a solid ball to pass. He's not going to be protected correctly. And so you solve all those problems in that particular part of the game, and then you move on to the next one. I caught the ball and I'm running it. Okay, now what do I do with it? In trading, it's the same thing. You have this market out there that has a non-existent commodity. If you look at the stock market, you have stock certificates. You have stocks to back that up. If you look at commodities, you have sugar or Kansas City wheat or whatever to back up the contract that you're trading. In currencies, you don't have anything to back that up. The currency is a ratio of the two currency pair countries, and the value of that part of the pair is based on the currency strength of that particular country at any given time. But there's nothing that you can say, oh, here's my stock certificate and I'm buying 100 shares of GM and here's my, $400 or whatever it is. So when you're looking at defining the problem, it has to what in software engineering we call encapsulate a certain thing that only deals with one aspect of the overall problems that are involved. So entry analysis does that for us. This is how I teach. And this is why I don't have very many students, is because everybody wants a secret sauce, a secret magic thing. And 90% of the people who have started watching this video have already left it, because my drop-off rate is about a minute to a minute and a quarter. And then people said, this guy's just going to talk. He's not going to have anything to say. I'm out. I want the guy that can give me the secret sauce. Well, I got the secret sauce. But the secret sauce isn't something that you can just boom, and instantly you're successful. You have to understand how to use the pieces. Just like if you're going to grow a garden. I can tell you how to grow a garden in 15 minutes. But you have to know, well, how deep do you have to shovel out, loosen up the soil? What's the soil consistency? How do you have to prep the soil? You know, all those kinds of things take time in order to put into order of execution, so that you can then go, oh, okay, I got to do this, and I got to do that, I got to do this. And then it becomes easy. And it's easy because it's simple. Currency trading is not easy, but it is simple. The easy part isn't possible in currency trading. Currency trading is difficult because you have that emotional construct that you deal with. Now, when I'm working with someone, I'm not going to preach the holy grail of psychology of currency trading, because that's counterproductive to actually learn how to trade. It's your responsibility to get a hold of your emotional structure. If you're fucked up as a human being, if your dad dropped you on your head when you were young and you hate him, or somebody aggravated you when you were young and it changed your attitude toward accountants or something. I mean, I don't know what your malfunction is, but if you have any of those malfunctions, all they're going to do is be exacerbated within the trading environment, because that brings out your raw emotions. I've always said that the best place to study human emotion is at the poker table. It could be in currency trading, but successful currency traders are the ones that you would see have a grip on their emotions, and so there's really nothing that you can see. Poker players have a very difficult time because they're dealing physically with the emotions of 5 other players, and their own emotions in this hodgepodge mosh pit of the poker table. So when we're looking at currency trading, it's simple because the problems are clearly defined. They're encapsulated. Entry analysis. We're going to talk about all the stuff around entry analysis. Position management. What does that encompass? And where does it change from entry analysis to position management? There's a fine dividing line between when you bridge that. And if you get it wrong, your timing on the trade's going to be off. It's like playing chess, what they call un tempe, which is a time element. If you make a small mistake, because white has the opening move, black is at a tempe disadvantage. White is at a tempe advantage. If white makes a stupid move, it costs him the tempe. Now black's a tempe ahead. In currency trading, you have to have your timing down on all of this stuff that you're going about from an emotional standpoint, because if you don't, you become a time element behind emotionally to this emotionless mosh pit of humans struggling to make $42. So I'm not going to cover that, because if you build your rules correctly, it takes care of the emotional process. This is what I teach students, kind of well, it would be a byproduct in their opinion as to the coursework itself. But to me, it's an integral part of building your emotional state. What kind of person are you? Are you short-term oriented? Are you long-term, sit on your ass and wait type person? I mean, that's a big difference in how you're going to write your rules, right? And so the emotional structure of you is a different problem to deal with within the life cycle of a currency position, which is the thing you're trading itself. I'm not dealing with the emotional aspect, because what I'm trying to do is build rules that are like a lock on a house. A lock doesn't prevent the house from being robbed, but it keeps an honest man honest. So a rule that encapsulates some emotional default that you may have as a bypass around that, just like if you knew you're driving down the road and there's a big puddle up ahead, you'd take a way around that. And so you can have those kinds of things in your trading rules that prevent you from stepping on your own face. So in the importance of entry analysis, that's that first phase of the life cycle of a currency position, because there are three things I want to talk to you about today. And the first thing about the importance of entry analysis is if you don't have an entry, you don't have a position to manage, and you don't have an exit, anything to worry about getting out of. So you have nothing to worry about. So if you can look at the chart and go, oh, there's nothing here to be concerned about. If my rule allows me, the conditions of those rules allow me to say, oh, well, there's nothing here. I go get a cup of coffee. I'm not worried about anything. So why would trading be stressful? Why would it be emotionally distraught? If you go to the trading desk with your emotions hanging out of your mouth, you're going to judge the second thing, which is a momentum calculation in your trading. You're going to judge that wrong, or you're going to do the opposite of that, which is you're going to do an anticipatory trade. And I'll go through those three things, no position to manage, wrong momentum, and anticipatory trades next. But I wanted to identify those. For those of you with short attention spans, you can now leave. You have the secret sauce. The importance of entry analysis, number one, is that without that analysis, good, solid analysis to put you into a trade that's going to move in the correct direction, the correct amount of distance in order for you to reach your profit target, that entry analysis is vital. And it's equally as vital to throw a flag and say, there's no trade to be made here. Because if there's no trade to be made, you don't have anything to worry about except how hot the coffee's going to come out before you can sip it. That simplifies your life. With good entry analysis, when you go into the trade, you're not going, man, I hope this thing does blah, 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 blah. There's no hope. There's conditions that the rule has satisfied that you've predetermined are important for you to happen in order to give you the highest probability that that price is going to move in the direction that you need it to move in for as far as you need it to move in, so you don't have anything to worry about once that position does what it's supposed to do, which is move in the direction that you need it to move in. But if you don't make the trade, you don't have a position to manage it, so you don't have anything to worry about. You have no stress. If you do make the trade, and it's going to be a loser, it's probably because you misjudged the momentum that price had. Maybe you got the direction right and you got the profit target right, but the juice just isn't there to get the price to the profit target within the 2-hour time frame window that you're trying to get your trades done in, or the 1-hour time frame that you're trying to get your trades done before you head off to work. How many of you have all day to sit there and wait for the trades? If you're trading on a 5-minute chart, as day traders do, you have 12 decision opportunities an hour to trade. So I could sit there for 2 hours and have 24 different opportunities to judge whether I have a trade opportunity or not. And with a general ATR and a major pair of about 5 pips, if I can grab 5 pips 3 or 4 times during the course of the day, I've more than made up for what a hopeful long-term trader looking for 100 pips is going to do, and setting his stop 100 pips south so that he's got some stupid thing called a risk-reward ratio, which I'm not going to get into. However, if your rules are weak and you find that you're not getting the results of that price momentum that you had hoped for, you know exactly where to go in the rules and try to fix that. Usually what happens when I work with a student, I go through this process with them during the training, they're always getting back to me saying, oh, okay, I'm seeing this occur, but I don't really understand if that's exactly what I'm seeing, and I don't really understand exactly how I'm supposed to respond to that because it's happening all the time. Is it me? Is it a statistical anomaly? Or am I just stupid? And it doesn't take long to try to clear that up because they have the broad-based problem solution as a whole that I've presented to them in the coursework that I've done. And so it's relatively easy for me to solve someone's problems. I have people that email me and they got this problem. I've been trading for 3 years and I'm not consistent, blah, 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 blah. And what's my problem? Oh, well, you're doing X, Y, Z. And they go, And then they ask another question. Well, you don't fucking ask another question because that was the answer. Now, if you haven't had good training, then you don't know how to respond to that answer. You don't know how to do that. And so you can't ask me another question like, well, how do you do that? Because that's a course. That's how I work with people. It's very difficult if you're on your own trying to learn this stuff on your own from some idiot that's trying to teach you Fibonacci levels or, engulfing candle patterns or I don't know what. Because you're hoping that is going to work. That person makes it work. Do you know that person can make it work? There's a lot of people just talking shit out there that really don't know what they're talking about. They're saying stuff that mathematically isn't true. Now, whether they can make it work or not is no reflection on their ability as a trader, but if they're able to make something that theoretically shouldn't work, then they're really not using that in the way that they're telling you that they're using it. They just don't know how to explain what they're doing. And so they pick a Fibonacci to tell you it's a Fibonacci that works because they don't know what else to call it. They don't know what else to do because they're not good educators. If you're not a good educator, you shouldn't be teaching. You shouldn't be showing somebody what to do. That's like somebody who doesn't really know how to drive a car other than they've read a book and done some videos and drove the car for 10 miles one time to the grocery store and brought back a 6-pack of beer and they all had fun. So now he's an expert driver. Really? You want to test your life to that? That's why when you're building your rules, if you don't have somebody behind you to say that sounds reasonable, more often than not, the thing that's going to happen is that you're going to get the strength of that price move incorrect, and it's just not going to get to the profit target. What happens is that you notice that it doesn't have that strength, and all of a sudden now, because you've invested so much of your life energy, your life force into analyzing that potential position and going through all the mumbo jumbo and getting involved and making trades and building a couple of and the thing isn't moving, you're psychologically invested in that trade. So you're probably going to hang on to that, hoping it's going to work out. And then when it goes against you and you're 5 or 6 pips down, you go, oh, well, I think I've got everything all right. This is just a normal reaction. It goes 10 pips against you. Well, let's just go up to the higher time frame. Oh, well, it hasn't bounced off the 50-period moving average on the 1-hour chart, but it's close to that, so it'll bounce off that, and then it'll come back, but it'll have to go 15 pips against me. Oh, my God, it's gone 25 pips against me, and so maybe that's just an anomaly, and it'll come back from that 1 hour, 50-period moving average. I mean, it just goes on. The ludicrousy just goes on and on. All because you got the momentum decision wrong. It didn't have enough juice, but you're in love with the trade. That's part of the emotional problem. And the third aspect here is anticipatory trades. You're doing your analysis, but your rules don't prevent you from saying, oh, the price is going to do this, and so therefore I'm going to go in now, so I'll get those extra 4 pips or I'll get those extra 8 pips, and then it'll hit that point. Well, what you're doing is projecting. That's not theoretical analysis. That's hope, fear, and greed projecting itself into your emotional background saying, oh, I think this is what's going to happen, and so therefore I'm going to do an anticipatory trade. You have about an 80% chance that an anticipatory trade is going to fail. If the anticipatory trade works, you're going to make an extra probably 10 pips on the trade. But it's 80% against you. You do the math on that. So you'll see that that's not really well. You can't think something. You have to know something. Lee Trevino, the famous golfer, went out and hit 1,000 golf balls every day. Didn't matter whether it was raining, didn't matter whether it was his birthday, didn't matter. Went out and hit 1,000 golf balls every day. And he said he hit that 1,000 golf balls every day so that when he steps up to the tee, he knows where his ball is going, but his opponent only thinks he knows where the ball is going. And that's the difference in how you construct your rules. Do you know that's what should happen from a theoretical standpoint to a probabilistic excess that it should go? There's no 100% certainty. You could have an absolute hyperbolic upward trajectory of prices over the last 2 weeks. Does that make mean it's going to continue that hyperbolic projection for the next 10 minutes? No, you don't know. And the probability of that point starts to become a degrading probability. In fact, the probability on an exponentially increasing element must in fact be an exponentially decreasing amount, because the elasticity of the movement has been overstretched. That's math and theoretical. That comes from my Bachelor of Science in Physics and all that stuff. But I can bring that stuff to bear to explain how the currency market works from a realistic standpoint, from looking at the nature around us. If you look at the fox, the way he crosses a river, he doesn't just run down to the bank and jump in because the current's too strong and it'll carry him away. He'll run way up the bank until he finds a solid place to jump from. And then when he gets there, the current's going and he jumps in and he just paddles lightly and the current carries him down. And when he gets across to the other side, he gets out. That's a Chinese proverb out of the I Ching, the book of changes. We look at the nature around us to see how we can conduct our lives in harmony with those that are more in tune with that nature than we are. So we need to look at the currency market in the hindsight of those who have gone before it and are successful at it, or have produced realistic, probabilistic analysis of what should or might or could happen, as opposed to what you think should, could, or might happen. And anticipatory trading is one of those things that you don't want to get involved in. So the importance of entry analysis is, number one, if you don't have a good entry, if you don't have an entry, you don't have anything to do. You don't have any position management or exiting of a position to worry about. You get a cup of coffee and you come back in 5 minutes and see if the next bar shows you something different. Number two, you get the momentum of that price move wrong. It's just not, this doesn't have the stuff to make it to your profit target. So what do you do at that point? What does your rule tell you that you should do? How do you compensate for that so that you don't fall in love with the trade? And number three, the eagerness to do an anticipatory trade, to get into something before it's anywhere near ready to being gotten into. Because it's anticipatory. You think it should do this because if it gets to here, it should do that. Well, if it gets there, it should do that. The question is, how likely is it that it will get there? Why don't you just wait until it gets there instead of doing an anticipatory trade with an 80% probability that you're going to be wrong? Why would you bet 80% against you? I don't know, but that's what happens. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.